It's fallen asleep already.
Right. So we've got our new one in and we're rocking. Look at that. So this is our new logo. What do you think of our new logo, Heather?
Oh, okay. You've actually added the little people to it, have you?
I've added the little people because we work with little people.
Wow. Okay.
Isn't that cool?
That is very cute.
So, yes. So today we are understanding financial accounts. We are Attain's agents, silver champions for Xero, and I am a certified bookkeeper. So that says that I may know something. Maybe, we'll see. So, accountable, it's Natalie and I are based here in Hawke's Bay. We do bookkeeping, financial accounting, business development, and financial recovery services. A new one that we launched end of last year. So we actually work with businesses in financial difficulty, mainly IRD debt, and we negotiate and an outcome within land revenue and help turn the company around. So if you ever hear of anyone in financial trouble, definitely send them our way because that's who we do a lot of work with. A truly successful business should provide the income to support the lifestyle you want and the discretionary time to enjoy it. Most business owners I know or come into contact with have one, maybe two of those things, but not three. So what would you say, Megan? Do you have the income, the lifestyle, and the time?
Missing the lifestyle and the time.
Yes, that's normally, you end up working 70 hours a week for no real benefit.
Yeah.
Yeah, so sometimes it is actually a case of looking at your financial accounts and working out, do I actually need to work that much, or can I do something differently to get a better outcome? So that's sort of what we're hoping to look at today. So give you the ability to then actually look at it and make some better decisions for yourself, because your accountant's probably not going to help you.
Yeah.
They're just going to tell you this is how much your tax bill is. So Orbed, and I know Heather participates in my SOS program. Do you want to do this for me, Heather?
No, go ahead. No, I haven't got my notebook on me at the moment.
So I run a SOS group supporting our small businesses. We are starting up our next group at the end of February. So that is sort of like a coffee group for small business owners to actually help you grow your business and hold you accountable, pretty much. Does it work, Heather?
So far, so good. It's certainly, if it's that consciousness that someone's there and having, yeah, when you yeah, that's another lurky there in the background. No, it's great. It's good. I mean, it's there for a motivator as well as just, because you're a small business, it's, for me, it's just me as the business. So having that connection with people as well that are at the same level as you or thereabouts, might be in different industries, so you're in different personalities. So you get to learn about, different things that perhaps you wouldn't have, or even get ideas from people. So I find it really, definitely worthwhile. When you put the time into it, and it's always what you put into it is what you get out of it. So, yeah.
Phew. Oh, so when I said that, I went, oh, shit, she could actually ruin this for me.
I wouldn't do that to you, Hayley. I might do it behind your back, but not to you.
Oh, go on, Heather.
I'm only kidding. No.
So, Orbed, have you ever seen this, Megan?
No.
No, so this is something that I work a lot with my business owners, and I sort of liken this to teenagers especially. So you ask them to do something and they will blame, say you, oh, well, I didn't hear you ask me that, so therefore that's why I didn't do it. They'll make excuses. Oh, yeah, but I couldn't because I hadn't saved my game on the Xbox, so therefore I couldn't actually do that job. They will deny that it even happened. So therefore, these are the reasons why they can't do what they should have actually done. So they are victims, and they justify their behaviour as to why they can't do something. And a lot of business owners actually do sit down here below the line. And you'll see it quite often. Oh yeah, but my competitors, they undercut me, and I'm not getting the clients because that wasn't a very good client, or something like that. You can sort of hear the negative thinking in the way they work. Whereas if a teenager took ownership and said, yep, you've asked me to do that, so I'm just going to go and do it, or they took accountability for it, or they actually took responsibility for it, then the job actually gets done. So these are victors, and they make a positive choice to actually do what needs to be done. So all of my business owners that work above the line are successful. And the reason for doing that is because they're making a positive choice about, yes, I could actually make an excuse why I can't do that, but I'm not going to. I'm just going to suck it up and do it anyway. So that's a real brief thing, especially when it comes to financial accounts. It's actually really easy to go, oh yeah, my accountant doesn't actually explain things to me properly. Oh, it's over my head, I just can't understand it. A lot of business owners will actually say that sort of stuff, but by all of you guys registering today, you're actually taking ownership of this and wanting to learn, which means that you are thinking above the line. So therefore you are in a position where you can be very successful in business because of your thinking. So some real basic things: separate your business from your personal spending. Take drawings in a lump sum. I used to work at Inland Revenue, and it was so interesting actually analysing business bank accounts when I got to see where people were going with their money. So it's always good to actually separate everything out. Reconcile your accounts daily to keep on top of it. There is nothing worse than sitting down and having 60 transactions and trying to remember what you were doing. Automate reconciling accounts as much as possible. Like with technology the way it is, we actually don't need to be doing the hard yards. We can actually do a lot of it automatically with AI coming in and all that sort of stuff. So another webinar I may look at doing in the future is maybe some training online for Xero, just showing some tips and tricks. But I'm going to send out some feedback at the end of this, and hopefully you guys can let me know what it is that what else you would like to learn. Use accounting software. Xero's not the right thing for everyone. So there's MyOb, there's Wave, there's quite a few different choices. Don't just go with Xero or MyOb because that's what your accountant wants to do. Go with what actually works best for your business. And Wave is free, so using Wave and you're not GST registered is better than not using any software at all. But I think the majority of people are actually all using accounting software, so that's cool. Take photos of your receipts. Xero and MyOb are both approved document storage facilities as far as Inland Revenue is concerned. So I upload all the receipts, all of our invoices and everything into Xero. That is our storage system. We don't need to have paper files anymore. So it's really handy to actually just email everything into Xero or MyOb, set it all up, and then you can throw out all the paperwork once it's actually securely stored. And if you no longer actually pay for your subscription, you will lose all of that data, so you do have to keep paying for MyOb up until that 7 years is ended. Xero, however, if you then decide you're not going to be in business anymore, you can actually stop paying for your subscription, and if IRD comes looking or anyone wants it, we can actually just start paying for your subscription again, and all your data is securely stored.
That's good to know. I did wonder.
Yeah.
Yeah, so it is always good for that, but you're not stuck paying for something you actually don't need. pretty sure you all know about taking photos, matching invoices to statements. The invoices are the important thing. I quite often see business owners where they go, well, all the invoices are written on the statement, so they throw away the invoices. The statement is not a legal document, so it's actually the invoices that we need to keep. So always keep your invoices, email them into Xero, and then you can throw them away. So bills, always enter the invoice number. Check that you've actually received the item. Quite often I will see people are trying to pay invoices for things they haven't even received, but they haven't looked at it. We do have a particular company that purchases goods from a supplier and the price is hiked all the time. So we're constantly having to check the amounts that they're charged. So if you're actually purchasing items to on sale, definitely keep an eye on the costs that you are paying and whether or not they're increasing over a period of time. Keep your invoices going. There is this thing in New Zealand, and it has been around forever and ever and ever, that you pay on the 20th. That is actually not a requirement. You can choose if you're a 7-day, a 14-day, 20th of the following month, 60 days after, whatever. You do not have to do the 20th of the month. So some of your really good clients, you might want to go 20th of the month. Others, it might be 7 days. Like, this is all about keeping your cash flow going. So just remember, just because it's the 20th of the month doesn't mean that's what you have to do. It's about what actually works for you in your business. Make sure you've got good terms of trade. And in your terms of trade, you should actually have something in there that says, if you don't pay the bill, then all collection costs are going to be added on, blah, 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 blah. Because then if that's what the terms of trade are, then it's not going to cost you to go and collect the money if it's not paid. And make sure that when you send out your first invoice, or the invoice has actually got the terms of trade on it, then you'll be all good to go. And email invoices as much as you can to save on postage. So this is probably all well and truly, you guys all know this. So now, the profit and loss. The profit and loss is so the profit and loss is sort of like your bank account. It's money flowing in and out of your bank account at any point in time. So you have all of your income coming in, less your expenses, and then what is left over at the end of the day is your taxable income. So that is what you're going to pay tax on. When you're working with accounting software, you go and send an invoice off to Joe Bloggs, and at that point on your profit and loss, the amount that you've actually invoiced Joe Bloggs is actually income on your profit and loss. You haven't received the money, but it is considered income. So you may have just sent out $100,000 worth of invoices, you've received no money back in, but your profit and loss is still going to say that you've made $100,000 worth of sales. So quite often I hear from clients, well, if that's what my income is, where's all the money? So because it hasn't come in. What we tend to do when we do our accounting is we look at it and we go, so you've got $100,000 worth of sales, $50,000 hasn't been paid, so then $50,000 of that is moved to your balance sheet. So I'll show you this further through. So then you can sort of see how it all works. But the basics is profit and loss is your income minus your business expenses equals your taxable income. So one of the big things to actually understand, and it really is handy when it comes to pricing, is what does it cost you to make the money? So we need to separate out in your profit and loss, and a lot of accountants don't do it. So ask them if they don't. It is always a good idea to know what are the direct costs of actually making that money. If you sold widgets for $10 and the cost of the widget was $5, then we want to actually identify that the cost was $5 and the income was 10. So therefore you're only making $5. Out of that remaining $5 comes all the other costs, like your printer ink and your tea and coffee and all that sort of stuff. So the cost of sales is actually really important. If it is say an engineer, they're welding wire, they're potentially their safety gear, all of that sort of stuff. If they didn't spend the money, they wouldn't have made the money. So that's a good way of actually thinking about what is a direct cost. You could have coffee. Doesn't matter if I don't have coffee. Morning, Erin.
Hello, hello. How's it going?
Good. It doesn't matter if you have coffee or you don't have coffee. You're still going to make the money. Does that make sense?
Yeah.
And for, say, a plumber, if they've got tradies that are actually going out to install a toilet, they're actually not going to make the money if they don't have that person going out. So the wages and salaries are often a direct cost. They can also, so then we've got the office lady who comes to work and sends the invoices and stuff like that. Would she be a direct cost? Probably not, because it doesn't matter whether we've got her or not. She hasn't actually earned us any money. She's just actually doing some paperwork. So therefore, she would be an expense to the business, not a direct cost. Does that make sense?
Yeah. Yeah.
Yes.
Yay. So when you're looking at your profit and loss, we have your total sales. So that's income coming from all areas of the business. If you've got multiple streams of income, it's quite handy to actually separate them out. So you would have, say, income coming from say normal customers. I'm trying to think of what's that word. Like you've got a shop and you're selling stuff. And so you've got people that come over and they buy stuff from the shop, but then we've got wholesale buyers as well. So we'd probably want to see who's actually earning us the most money. Is it actually the wholesale? Is it the actual over-the-counter sales? If it is a engineer or a plumber, you know, is it repairs and maintenance? Is it new builds? Is it design work? Where are we actually getting our money from? And then in the cost of sales, it actually makes a lot of good sense to break down. So this is the cost of that income. So then we can actually look and say, well, we made $100,000 here, but $90,000 was the cost. And on this one, we've made $60,000, but it only cost me $5,000. So then you can start to see where the opportunities are for you to make more profit. So that's always good to break down your income, break down your cost of sales, and then we're left with the gross profit. So your gross profit is the amount left over once all the cost of sales have been taken out of the income. Because remember, you wouldn't have made the income if you didn't spend the money to make it. Your business expenses, advertising, office expenses, power, motor vehicle, if it's not actually a cost of sale, all that lovely, you know, mobile expense, that actually all needs to come out of your gross profit. And then at the end of the day, when everything is done, you are left with your net profit. And that is what you're going to pay tax on. Your net profit, if you've got loans that you're repaying, so you've gone and bought a new vehicle, those repayments are not going to come through your profit and loss. Those repayments are going to come from your net profit. So remember when you say, I've got $20,000 worth of net profit and I'm paying tax on $20,000, that does not mean you've got 20 grand in the bank, because all your loan repayments and your drawings have actually come out of the net profit. So quite often people will say, if that's what I've made, where's all my money? It's all gone on loan repayments in your drawings. Make sense?
Yeah.
Yes.
So for a company, we will actually run down the business. So if you're a limited liability company and you've got 20 grand in the 20 grand profit in your company, we will actually then suck that all out and give it to you personally. So on your profit and loss in the business, you will actually have $20,000 expense of shareholders' salary. So then there'll be no profit in the business at all. It will just be nothing, which means with no taxable profit, there is no tax to pay. What that does mean though is that you now have a tax bill because you've now made 20 grand profit. And the reason why we do that is you'll see from the slide, the tax rates for an individual are a lot less than the business. Once you get to $70,000 though, we're better off leaving the money in the company because the company pays less tax than what you're going to. Have you ever come across this before at all?
No, that's really interesting.
So it does make sense to, you know, and it is very case specific. If there's a reason why you need to have more money, then we can, but then you're going to pay more money than what your company would. So it's about structuring your taxes the right way to actually make sure that you're not overpaying in tax.
And that's the advantage of the limited liability company. If you've got, say, shareholders and you're sharing the profit. So
yep,
and if you're a sole trader, could you do the same?
No. So if you're a sole trader, you're just going to pay the tax regardless.
Right. Yep.
So,
but you'll be paying a lower rate anyway.
If you're a company, or even a sole trader, and your children are actually helping you in the business, you can actually employ your children, which sort of gives you an expense. It reduces your tax liability, and then your children have then got the money to be able to go and pay for their own school fees or their own uniform or something like that. So these are costs that you're going to have to pay regardless, but by putting them on payroll and actually giving them a wage, it reduces your personal tax bill and it makes the children have to manage their money, and so you're not going to end up paying for these items twice. So there are rules attached to that. So just make sure that you think about your situation before you just blindly go and put the kids on payroll. You know, if they're 4, they can't be earning minimum wage. So the balance sheet. So that's pretty much the profit and loss. Is money coming in, money going out. This is your tax bill. Make sense?
Yeah.
So the balance sheet, I sort of, and accountants refer to it as the statement of financial position. Sounds scary, but it's just a balance sheet. And what it is I liken that to, it is a family photo. So at any point in time, you can get all your family together, you can take a photo, you've got ugly ones and you've got good ones, and that's what it is at that point in time. So when we do a balance sheet that is at that point in time, that shows all of our assets, so our bank accounts, our accounts receivable, people who owe us money. It shows us our assets, which are cars and plant and equipment and things like that. And it shows us all the ugly ones, like the BNZ bank loan or the GST bill that needs to be paid, or your shareholders' current account. So they're all the liabilities. And the balance sheet, all that means is at the top, this is all the good stuff about you. In the middle is the liabilities. This is all the bad stuff about you. And when we take the top minus the middle, you're left with the bottom, and that's your owner's equity in the company. And what owner's equity is the difference between assets and liabilities. So if you've got $50,000 in assets and $30,000 in liabilities, you've got $20,000 equity. If you've got $30,000 assets and you've got 50,000 liabilities, then you've got negative 20,000 equity. So that's all that means, is this is the good stuff minus the bad stuff equals end figure. The balance sheet is good to keep an eye on. So GST, for example, if you were to get a GST refund, it is no longer a liability because there's money coming back to you. So then on the balance sheet at that point in time, it could actually be an asset because it's money coming to you. You will often see accountants may actually split assets. So it'll be like current assets and non-current assets, and they do the same thing with liabilities. All that means is current assets are things that you will benefit from within the next 12 months. So a bank account is a current asset because we can go to the bank and draw out the money. We get that immediately. We can sell off our inventory, so we get that money immediately. If we've loaned someone money, if we have loaned someone money, which is on a 3-year repayment term, that is non-current because we're not going to get that back within 12 months. So that's all that means, is when they split it out and go, this is current and non-current, that is going to be received in 12 months, not going to be received in 12 months.
Right. Okay.
And this is the big one. So if you're a company, this does not apply if you are a sole trader, but if you're a company, your shareholders' current account is the key thing that you need to keep an eye on. And when I was working at Inland Revenue, I would quite often see accountants who just kept allowing the business owner to suck more and more money out to the point where they had an overdrawn current account, which then becomes an asset to the company because you now owe your company money. And we would get really excited about that at Inland Revenue because then we'd go, oh, suddenly we can actually go after the business owner because they owe the company money. And then if the business owner didn't pay all the money back to the company, we could then actually attack the business owner's personal assets. So you do lose part of that limited liability if you've got an overdrawn current account. So your current account is formed. So when you create your business, you normally put in, say, $10 or something like that to start your company up because you need money in a bank account to open it. You then go and give it some assets. So it might just be your personal car is becoming a company car. The business doesn't pay you for that company car. It just sits on the balance sheet to say, the business acknowledges that we owe Joe Bloggs $10,000 for his company car. And that will just sort of sit there and it becomes a liability for the business. So quite often I'll see a company's got $50,000 worth of assets, but they've got $160,000 of liabilities. But $150,000 is actually owed to the company director themselves. So therefore, he does actually have equity in the business because he actually is owed all the money. So there are no liabilities. He's the only liability. The way that the shareholders' current account works is that you only pay tax. So you could earn $10,000 on your profit and loss. And that is all the money you pay tax on. You could have taken out $50,000 in drawings. You're still only going to pay tax on that $10,000, but the remaining $40,000 is going to come out of your current account. So if you only have a $20,000 current account that the business owes you money, you've taken out twice that amount. Suddenly you need to pay that back to the business. Does that make sense? Tell me if I'm actually not making sense.
Yeah. Yeah, no, I see where you're coming from, yeah. And this is something that I wasn't aware of until now with my other business or other accounts that I was transferring money to, putting them aside into different pots for different things.
Yeah. Yeah, so it's always good to keep an eye on that current account. Actually talk to your accountant and actually say, what is my current account looking like? Is it overdrawn? If it is overdrawn, you then have to pay interest. So therefore, in your financial accounts, you'll have a line and it'll say something about shareholders' current account interest, and it will be income, which then increases the tax that you're going to pay, because it's income to your business. The fact that you've overdrawn this amount, it's effectively a loan. So you sort of get screwed every which way. You lose your limited liability. You then have to pay interest on the amount of the money that you've actually taken out of the business, which then means that you pay more tax had you just managed your current account properly in the first place. So that pretty much is the one thing. If you get nothing else out of today, your current account is the most important thing if you are a company owner. If you're not a company owner, ignore everything I just said. There you go. Always have a budget. Doesn't matter how big your business is, you do need a budget, because for you to continue growing your business, for you to do the right thing and actually be inspired, you need to have goals, you need to have targets, and you need to challenge yourself, and a budget, a good budget, will actually help you do that, and it will help you drive your business forward. And maybe that's another training issue. How do we actually set a budget? Might do something like that. Always stock take at the end of the financial year if you have inventory or stock. Count all items, do not estimate them. I had a client that would sort of look at a box and go, oh, there's $50 in there. That actually wasn't correct. And they were a long way out. So really keep an eye on it if you can, and you do have a lot of inventory. I highly recommend putting in an inventory system. Xero has one included, not the best. So if you are actually doing lots and lots of inventory, there's probably a different option we could use, but you're better to do something rather than nothing. And inventory forms on your balance sheet. So when you look at your balance sheet, it's an asset, which is a current asset, because you can sell off all that stock and get the money within 12 months. Always keep your stock area tidy. And from what I have seen, so working at Inland Revenue and IRD and all the other places I've been, the stock is the one area that a lot of small businesses lose money, is because staff just borrow something and never return it. And because things are a mess and they don't have the right systems in place, no one will ever know. So you do lose a lot of money in this area. So it's something we've got to really keep a good eye on. And maintain accurate records in the cloud. So if your business premise burnt down, the insurance guys are going to come to you and go, well, what was your stock level? And if you can actually just pull it up and go, here it was, then that's how much money you're going to get. There's going to be none of this, oh, well, I did it on paper, but it was in the office and it's now burnt down and I think it was about this. And so there is a real good reason for keeping things up to scratch. And my personal favourite, home office claim. So your home office is not a home office if it's a bedroom. So make sure there's no bed in your home office. Mm-hmm. So, and this is one, and you know, just something else that we can put on your profit and loss to reduce your taxes. We claim a portion of your insurance, your rates, your power, your phone, your mortgage interest or your rent, internet. There's a whole bunch of things that we can actually do here. So make sure that you talk to your accountant about how can you maximise this home office claim. I'm always advocating to actually get this through, supply the paperwork when you're requested, because this is a good way of actually reducing your tax bill. But just make sure that you don't push it too far and end up breaking the rules. And depreciation is another one of my favourite items that we can put onto your profit and loss, which reduces your taxable bill. Depreciation is an acknowledgement from Inland Revenue to say that we know business assets are not going to work forever and ever and ever. So we're going to allow you to take a deduction every year to then actually offset against your tax bill, because in the future you're going to have to buy this equipment again. So the expense reduces your taxable profit, which in turn reduces the taxes you pay. An asset is any item over $500 that is used in the business. So if you go and buy 100 sheets of jib and the board and the bill is something like $5,000, that is not an asset because you're going to use that. That's a cost of sale, so that will go through as an expense. But if you go and buy a new phone and it's $850, then that's an asset, and that goes onto your balance sheet as a fixed asset. The important thing to remember is when you buy assets, so you could look at your profit and loss and go, oh, I've made $30,000 this year. Let's go out and buy a new vehicle to reduce our profit so that we don't have to pay tax. Any asset does not go through your P&L. So any asset you buy is not going to affect your taxes. All that's going to do is you're going to get an allowance for depreciation on that asset. So quite often people will go, shit, $50,000, let's go and spend it. They'll go out, buy a car, and then I'm like, well, here's your tax bill, $50,000 profit. And they said, yeah, but I went and bought a car. And it's like, yes, but that's an asset and sits on your balance sheet. It's not money in and out of your bank account that affects how your business is run. I may not have explained that very well. Did I explain that well?
You did.
Perfectly.
Sorry about the
Yay! So assets have different categories of depreciation, so there's all different amounts and all that sort of stuff. As business owners, you're not expected to actually know what they are, but a vehicle is 30%. So if you've got a $10,000 vehicle, every year you're claiming 30% of that. A cell phone is 60%, so if it's a $2,000 cell phone, you're claiming 60% of that every year. So the basic ones that you've got, it does actually pay to know what it actually is, because when you go and get your financial accounts and you see what the accountant's doing and the rates that they've put on them, they may not have put the right rate on them. So you may be claiming too much depreciation or not enough depreciation, and this is, you know, at the end of the day, you're signing the piece of paper to say that you accept all responsibility for the work the accountant has done. So you need to know that what you're signing is actually correct. So if you've got any questions or anything like that, feel free to flick me your financials and I can give you some pointers on ideas of what to talk to your accountant about and things that you may want to learn to help you further along. GST, I love this. GST, I'm pretty sure you guys know all about it. File 2 monthly, monthly or 6 monthly. You do not have to register for GST until your turnover is going to exceed 60k. GST is not your money. It is collected on behalf of the government. I once had a lady who said they were going to reduce their rates because they didn't want to collect money on behalf of the government. That's very short-sighted. So it is what it is, but just make sure you put that aside. You don't want to have IRD chasing you for money. Common mistakes that people make is they register for GST before they need to. So if you're going to go out and buy a new car for the business, it makes sense to actually register for GST because you can claim back all that GST on that vehicle. The only problem is when you've claimed all the GST on that vehicle and then you want to actually go and sell that vehicle, you've got to pay the GST back, whatever that value of the vehicle is at that time. So don't think I'm just going to go and get the GST back and then not pay it back. You will always have to pay it back. So it's about making sure you're doing things for the right reason. So make sure you talk to your accountant prior to making decisions so that it can be structured correctly. I did have a client who thought they were being really, really clever and didn't want to hassle me. So he sold a vehicle and he bought a vehicle, and the end result was his tax bill was twice the size of my annual rate. And I run his company for him. So if he'd just spoken to me, we could have saved him a truck ton of money. So just always ask the question. Don't think you know the answer, ask the question. And if you then get charged to ask that question, find a new accountant. Always go payments basis. Invoice basis is only for great big huge companies because they can actually afford to pay the money, whereas little business can't. What I see is people forgetting to claim some costs. You know how you go down the road and you fill up your car and you left your business EFTPOS card at home, so you use your personal card and then you forget to actually transfer those costs into the business, so therefore you're not claiming the GST, you're paying too much. Charging GST before you've registered, or not charging when you are registered. So you can only charge GST when you are GST registered, and vice versa. And if you have to deregister, you've got to return all the GST claimed on the assets that you still owe at that time. So for GST purposes, you don't need a receipt for anything under $50. So where people say, oh, don't worry about it, if you haven't got the paperwork, we don't need it, it's under $50. That is correct. For GST purposes, under $50, you don't need paperwork. You then, for anything over $50, you need something that actually says this is a GST receipt and it's got the GST number of the company that you've bought it from, and you need to hold all those documents. However, when it comes to income tax, if you don't have those little $50 receipts, then the IRD do have the ability to go, well, you don't have the paperwork to prove it, so therefore we're not going to allow it as a claim. So always keep every receipt you possibly can. And I say to my guys, you know, you go down the road, especially if you're on Xero or MyOb, you can actually go to the petrol station, you fill up your car, they give you the receipt, you take a photo of the receipt, you throw it away, job done. So it is really important that you don't lose receipts, even though it's not essential in some people's eyes. So, how are we going? Are your heads exploding?
No, I'm doing well. I'm still here. I haven't fallen asleep yet.
Oh, good. Keep sucking that energy drink.
I've just got my audio on mute in case a plane flies over again or the dog barks.
Right. Okay. So one person actually said they wanted to learn about pricing and how to do it. And this is a really basic way of pricing. Like, there is so much to do when it comes to pricing. You know, there is understanding your value. And after this, I'm going to send you out some feedback forms with a couple of links to some videos that I particularly like. And one is about pricing and understanding the value that you actually bring to your clients. We need to move away from, this is what it costs me to do it, and then this is what the labour is, so therefore you pay me XYZ. We need to actually look at it and go, right, so this is what it cost, and this is the value that you're going to benefit from me doing this job for you. So then there's a value on that value, and so you're now going to pay me this. So it's about understanding what you do to help your clients to then actually set your costs. So that's complicated. And it might be something that we actually run a whole separate webinar on. But I sort of work very loosely on, you know, if you don't have employees, the third model. So you've got a third is direct cost. So you need to know this is what it costs me, and that will include labour, your widgets that you're buying, your consumables, or whatever it is that if you don't do it, you won't make the money. So that is 1/3 of the price that you charge. Then your overheads are another third, roughly. So then that is all your advertising, your telephone, your power, your home office, your depreciation. Like, don't forget to add in depreciation and home office here as well. because these are costs that you're going to have at the end of the financial year. So then that's another third. And then the last third is your drawings, the money for you. Because quite often business owners will look at it and they go, oh, well, it cost me this much, so therefore I'm going to charge that much, and then this is the business expense, so then that's the amount. But what they're forgetting is that they're not adding on anything for them to live off. So always make sure that you've got your direct costs, your overheads, and your drawings. You put all that together, and then that's what you actually need to charge. Now, I always sort of say, you know, when you're looking at your budgets, like we want, if you go back to the beginning, have you got the time? Have you got the lifestyle? Have you got the money? We look at that budget and we say, right, we want XYZ amount of money. We start at the bottom with your budget. So that is what has to come out of the bottom at the end of the day. We then add on, these are all the expenses in the year. So that's all our overheads covered. So then we need to add on, this is the direct costs for us to make some money. And then we end up with sales and we go, right, this is what we actually need to earn to make all of this happen. And if it comes out that that top figure is $1 million and there's no way that your company can do that, then we need to actually look at what's happening in the middle. Do we need to make better decisions? Do we need to actually look at repricing all your insurances? Do we actually need to look at how much you're paying people? Are you overstaffed? Which is actually a really common thing that a lot of employers do. And so that is always a really good way of actually understanding this is what my price actually needs to be. And then if you do have employees, I work on the 25%. So 25% employee costs, 25% direct costs, 25% overheads, 25% drawings. Pricing is really complicated, and this is just a real basic way of thinking. So if you've actually got real specific questions around pricing, feel free to email me through. I'll flick you an email back. Won't be this week because I'm heading out of the office. But I will actually come back to you and answer your questions, because you know we're very much about empowering business owners to help them make their own decisions. And if we can help you have that conversation with your accountant, then that's while we're here. So that is a really brief overview of financial accounts. I hope it's made sense. Has anyone got any questions? Please make something up if you don't. So hang on, let me say this. If you had a question, what would it be?
Hey Hayley, can I ask something?
You can ask something, Erin, because the other two are too scared.
Sweet, I'm just unpacking groceries and stuff, but getting...
She disappeared.
So from this, I haven't tracked that well.
You keep cutting out, Erin. Flick me an email. Are you there, Erin? No. Megan or Heather, do you have any questions? Or do you want me to cover something off again?
No, you covered it amazingly. Thank you so much.
Good. So has it helped you in understanding your business now?
You sit down.
Yeah, definitely. It's filled in a couple of the blanks that I had, and it's made things so much clearer. I get it so much better now, so thank you.
No worries. I'm pleased that we could help. And yeah, if you wouldn't mind, I will be sending out some feedback form. We are developing our education plan, so we're rolling out quite a bit this year. One thing that we will be doing is business planning in March, which is where we're sort of getting businesses together to actually brainstorm and help each other create that business plan, and then also form that accountability as well, so that if you want to actually do well in your business, then you're going to be forced to do that, unfortunately. One of the big things that I promote with all of my clients is that you have to have a holiday every year, and I don't care what the business is, you need to take a break. So that's one of the big things that we'll be focusing on through this business planning workshop, is about how are you going to take some time out, and it's got to be really good family time out. And I'm quite hot on that one. I think Heather may actually agree with me on that.
Oh, yes, I do. Looking
So,
forward to this.
So I will keep you in the loop as to when we're doing things, and some of it will be here face-to-face in small groups. A lot of it will actually be online, because it's, I think, easier for small business owners to just take an hour out rather than a full day. Did you manage to, have you settled yourself, Erin? Do you want to finish your question?
Hello, yes, I'm back. Sorry, our internet. Yeah, my question was around getting your head around this for network marketing and no inventory and no a bunch of different things. So just wondering if there's some resources for that. I'll sit down with you obviously as well. And I've got a whole team of girls who've come into this as a hobby, and all of a sudden we have businesses that were going, wait a second.
Yep. Yeah, and it might actually be that if you've got a whole group of them, why don't we just run a session for them and your industry on its own? So then you guys can all ask questions, because I don't know if you guys know this, going into business is actually really easy. Running it is not. So, and there is so much information in Google, and it is really conflicting, and you don't actually know what applies to you, what doesn't. And the people that actually should be there to help you don't. So therefore you end up feeling dumb and you don't ask the question, and then you just flounder away, and eventually you work it all out on your own. So let's shortcut that and actually just get it sorted and move forward. So if you want, flick me an email and we'll see if we can run a webinar just for your guys, and then because you are specific industry compared to everyone else.
That would be amazing. Even about having a bed in your office. Our spare room is our office. It's got a bed in there. And been working with an accountant for a year, and none of this stuff, like it's all, I'm just hearing it for the first time. So yeah, that's awesome. Thank you so much, Hayley.
No, and I think the other thing that we didn't cover off is your motor vehicle. Keep a logbook for 3 months, tracking what's business, what's personal, because then we can actually start claiming the percentage, that percentage. So if you're 50% business, 50% personal, we can actually claim 50% of your motor vehicle costs. So that's 50% of your fuel, 50% of your rego, your repairs and maintenance, all that sort of stuff, your tyres. We can start claiming that in the business.
Yeah, awesome. That's huge.
So keep it, and at the end of the day, if it turns out that your motor vehicle is only, say, 2%, your usage for business is 2%, then we can actually do a K rate, which generally turns out to be more than what that other rate would be. So we've got 2 ways of going, but that logbook with your Ks and the logbook to show percentage is important. So make sure you do that as soon as possible. And that will sit in place for 2 years. If your business changes and you suddenly start using your business more, then do another logbook. You don't have to wait 2 years. So, but any questions, feel free to get in touch. If you want to learn more about Accountable, we're a bit weird and wonderful around here, flick me an email, give us a call, or check out our website. Send me feedback. If you think the website sucks, I'll change it. But otherwise, keep an eye out on what we've got coming up. We do have our next SOS group starting in February. We will be running our own little business awards in November for all of our clients. So it is about actually creating a community to help you grow. And we also will be starting an SOS group online. So I'm just running that one at the moment. So we'll be starting that one at the beginning of the next financial year. So Erin, if you're keen, you might be able to slot into that one next financial year.
Yeah, super keen. Thanks, Hayley.
No worries. Have a fantastic day, guys. And any questions, send me through your financials, flick me an email. You've got all my details. And yeah, we'll be in touch. Hopefully you'll get to come to the next session that we run.
Great. Thanks, Hayley.
Thank you.
No
Thank
worries.
you.
Catch you later.
Thanks. Bye.